Thank you very much, Julianne, for the introduction, and welcome everyone. I do have a favor to ask, which we're a relatively small group, and I would rather if we can run this a little bit more like a workshop, more conversational than just me presenting through slide decks. There will also be some moments during the next hour when I'll ask you to just take a minute, pause, think about your business idea and where you're at with it, and just jot down some thoughts. So running this a little bit more like a workshop than a presentation. Okay. Yes, Jay Wisdom? Okay.
Oh, no.
Oh, that's okay. And everybody can mute or unmute as you go. Feel free to interrupt if you have questions so that we can address those as we go. You all are likely to have questions that are relevant to each other's ideas and position currently developing your Big Bang ideas or other business ideas. So let me just ask very quickly, and a little bit more about my background and why I sort of enjoy this show me the money presentation and some of my background in it. So I do have, okay, thanks, Camille. I do have a lot of leadership experience in the nonprofit world, in the for-profit world, and in now sort of in a government position here at the UC Davis. At various points in my career, though, I've also done valuations, which is what we call it when we go out and look at a company and look at its financials and try to determine what that company is worth. I also did some work with a private equity group where we were with a really interesting and very specific focus on what's called mezzanine debt. So that was a really interesting insight into how private equity funds startups. So that's some of my background, but let me ask very quickly if anybody can pitch in, whether you want to turn on your video or type it into chat or just speak up. How many people here are planning to submit to the Big Bang and already have a business idea or you're already on a team? Just jump in.
I am not on a team and I don't plan on submitting, but I'm interested in, I have kind of an entrepreneurial, I'm learning I have an entrepreneurial spirit in a sense.
Okay.
And I work in corporate finance too, and I've seen a lot of my colleagues kind of branch off to do small business, like kind of, open up their own brewery and stuff like that. But
Okay.
being in the corporate finance world, I'm just usually assigned to forecasting one GL line.
Right.
But when it comes to if I were to stand before investors outside of watching Shark Tank, I don't really know. So no, just came interested to learn.
Great. Do you have you don't have a specific business idea right now, right?
No, not right now. I know I do want to start my own business one day, but not a specific idea right now.
Great. Ty, I saw your you posted in chat there. Do you have a business idea, and can you give us just the 30-second version of it?
Yes. Yeah. So our idea is building a LLM-based course assistant for courses. So previously, I was a TA in the computer science department, and we have lots of large classes with hundreds of students, but we don't have a lot of TAs to answer all the student questions. But also existing LLM services like ChatGPT can give misleading answers, and that's what we're trying to improve. Is that we're building our language models, we're building our inference methods to make sure that the answers are relevant and appropriate to the course. And currently we're piloting our services in like 4 computer science courses. And we already submitted to the feedback round. So we're gonna incorporate some of the feedback and we're gonna submit to round 1.
All right, terrific. Thanks for sharing that, Ty. EdTech, into the EdTech sector.
Yeah.
All right, Nitin, would you mind doing the same? 30 seconds on what your idea is?
Sure. So we're focusing on helping patients with chronic conditions solve their essentially caregiving type needs. So these are, making appointments, doing transportation type of stuff, and just coordinating their caregivers for the services that need to be done. Very patient focused rather than practice focused.
Okay, and is this an app or more of a service or
It'd be a social network essentially.
social network?
Yeah.
Got it. Okay. Steven, do you have an idea you want to present real quick?
Yeah. Hi,
Go
Jim.
for it.
Pleasure to meet you. Yeah, so Campus Mind is developing a student information system advancing the culture of care at U.S. colleges. We operate a gamified interface for students to take daily surveys, save favorite resources, and earn awards in the app. And administrators on campus are provided an interface to manage key resources and identify metrics on student satisfaction and the impact of the resources make on campus. So we are a B2B and we're licensing our product directly to colleges. And we're working after 3 years of traction and prototyping with Sac State. We launched our product this semester and we're currently piloting at Chico State and Sac State and looking to expand to further colleges with investment.
Great. So you have customers.
We have 30 registered student users, and we have 200 plus surveys, market research surveys. So we're still trying to really get our pilot launched off the ground with our student ambassador program.
Got it. Okay. Thank you, Stephen.
Yeah, absolutely.
Anyone else who has a minute or 30 seconds and just wants to give the real quick intro to their idea or where their business is at? Okay. Thank you very much to those who did. And as we go, if you want to pitch in, give us a real quick intro in either while you're asking a question or in reference to something I say, feel free. I am going to use these examples as we go along and try to tap into specifically some of the questions that I might ask you if I was an investor thinking about your business or what you might want to be thinking about as you build it. Okay, so thanks very much to those who shared. As is the tradition, I'm going to share a deck here on the screen, and I would, as we go, it's going to take a second. My computer's going to go dark here for just a second on you. Okay, hopefully you can now, we're getting there. Stephen, if you can nod when you see the slide. Great. Okay. All right, I am now more or less arranged the way I want to be. Okay, so today's session is called Show Me the Money, because what we're going to look at is how does the market think about your business and how are you going to get the investment dollars to launch it? So some of the things that I'm going to cover, some of the questions I'm going to try to help you answer is, first of all, just what is the value of your enterprise? How to think about value in the investment market, which will involve introducing some really simple financial basics. I'm going to run through those pretty quickly, but I just want to introduce them, and then I'll share this slide deck later, and there's lots of good resources online to understand the concepts that I'm going to talk about. Then we'll review some business model basics that if you've been attending the series for the Big Bang, you will have already seen, but I want to reinforce how they influence the valuation of your enterprise. And then we'll talk about how much do you need to raise, how to think about that, how do you raise it, who invests when in startup enterprises, and then how will you return your investors' money, okay? And the results, or what we're aiming at here, is to help you be able to make a compelling pitch for investment in your business. Okay, so that's what I'm expecting to do. Does anyone have any comments on these topics? Is there anything specific that you want to raise right now about any of the topics, or does this look right in terms of why you showed up today? And by the way, as we go, I'm going to take silence as assent. But if you want to add something or comment on this, please go right ahead. Thanks, Jay Wisdom. Does anyone have a specific question you want to make sure I answer about any of these topics as I go along? Any burning question on your mind that's specific to where you're at right now?
Jim, I'll be looking at the chat.
Okay,
So I can raise questions that are asked in the chat. And there's one from Stephen. Will you be addressing investments via grants as compared to VCs?
I will mention that as we go. Yes. Yep, I will mention that as we go. It is an important part of the startup process, especially for a lot of people who start up on the university. Okay. Well, if you haven't asked your question now, don't let that stop you later. The floor is always open. So I'm going to start with what might seem to be an odd question. This is a pumpkin pie, but it can be any kind of pie that you like. What would you pay for this? Go ahead and put your price in the chat. $5. That's from Steven. Anybody, what would you, and this is a full-size pie, by the way. It's not like one of the hand pies. It's a full-size pie. What would you pay for a pumpkin pie? 8 from John Paul. 8 from Nathan. 5 from Linda. Okay, so why those numbers? Where do you get those prices? Why, Nathan, do you say 8?
Well, I was just thinking about how much it was the last time I had the full pie.
Absolutely. Absolutely. Anybody else? Why'd you put the number in that you put in? Costco, good. Yep, if you can find one of these at Costco for $5, that is reasonable. A bakery store. And Linda, is that the price you would pay at your bakery store? Is that why you put 5 in? I'll take that as a yes. So, exactly. So why is it the price? Because we know of examples where people buy and sell pies for $5 or $8. Looks like about that quality of a pie that I would find at the supermarket where I shop for $8. That's what I would be willing to pay. I might actually be willing to pay more, but not if I can get it for $8, right? If I can find the same pie for $5, I would pay that. But what value do we put on things in a market? It's the value of a thing is what a willing buyer will pay, that a willing seller will accept in an arm's length transaction. Now, the market for pies is a pretty thick market. They're bought and sold all the time. So we all have benchmarks as to what a pie is worth. We also know our personal preferences for pie. So depending on the place, depending on past experience, we're willing to pay more or less, but it's a thick market. The market has settled around $5 to $8. That's what we're willing to pay. But how do you value a startup, right? This is still the same thing. It's a market. But how do you value what your startup is worth today as you look forward to? So let me ask a slightly different question. What's the value of this $100 bill? If we were in a room together right now and I had a $100 bill, how much could I sell it for? Anybody, it's not a trick question. How much can I sell $100? Exactly. I could sell a $100 bill for $100. We don't do it because sitting around exchanging $100 bills would be pointless. But we all know that the value of $100, as I sit before you today, is $100. Now, let's say instead that I'm selling you a certificate of deposit that matures in 1 year and will pay you, right, $104. Okay, I guarantee you're going to get $104. I am backed by a very important bank. You will get $104 or $105. How much will you give me for that today? 1 year. 1 year from today, we all get back together on February 21st, 2025, and I'm going to give you $104, guaranteed. How much do you pay me for that today? And how do you make that decision? Not a trick question.
Or would you compare against other possible places you could invest the money and then
Other
see?
investments, right? So I mean, it's a $100 bill, so it's a 4% return in 1 year guaranteed. As you look at the market today right now, what do you think? What would you give me for $104 1 year from today? Is anybody currently earning less than 4% on $100 sitting in an account? Because if you are, you should take this deal. You'll at least get $4 in a year.
So I'm thinking that I should give you I should multiply that $4 to at least match the 100, right?
Oh, I'm
And
giving you $104 a year from
You're
now.
gonna, yeah, but you're gonna give me back 104. So if I want to really gain on giving you $100, right?
Yeah.
I probably want to give you like 1,000 or $2,000 for that $4.
Because you want that 4% multiple times is what you're.
Yes,
Okay.
yes.
But if I only had one of these certificates of deposit, would you give me $100 for it? And get the
And
100
I'd have to,
a year?
and I'd have to wait a year to get
Yeah.
a +4? No, probably
No,
not.
not enough. But you're saying if you had 2,000, you'd do it for 2,080. It sounded like you were willing to do it for a larger volume, but the same percentage rate. Is that right?
Right. Yeah, well, when you
Wow.
say it that way, it doesn't even sound appealing at all.
So Nitin says he would do a T-bill. What's a T-bill running at right now, Nitin? A T-bill is a treasury bill backed by the US government. What's a T-bill, what's the rate on a T-bill right now?
4.63 is what it says.
Okay,
it's a-
and why would you go with that instead?
Well, if there's no risk, I mean, I'd prefer to be backed by the government rather than some.
Absolutely, and you get that extra 0.6%, right?
Yeah.
Okay. So when you think about this, there's a couple of ideas to unpack in this conversation. One is that the future value, let's go to $1,000. The future value of $1,000 invested in a T-bill is $1,046 in a year, right? You can invert this relationship. You can say that a cash flow guaranteed by someone as big as the US government and certain as the US government, a cash flow of $1,046 in a year has a present value of $1,000 today. Okay, and this is called the time value of money, and this is how investors think about any investment at all. Okay, you move the cash flows back and forth in time and figure out what the present value of an investment is. All right, and we all do this all the time, sort of intuitively, but in the finance world, you do it with this simple formula. Okay, and I'll just run it really quickly. The present value of a cash flow at a certain time n is the present value is equal to that cash flow divided by the period discount rate, your interest rate, if you will, times the number of periods. So if we were to look at this in the example we just gave, our expectation is a 4.6% return in a year, and we were promised $1,046 in a year. The present value is $1,000. Okay, that's the simple version of the present value formula. And again, this is how the market thinks about a business. This is how the market thinks about investments of all kinds, from investing in big corporations to your enterprise, right? And one of the things I want to emphasize is basically the money market doesn't care about your idea. Okay, the money market, most research shows, doesn't really care about the social impact of your idea. What the money market cares about is the future cash flows that they can hope to get from a business that you're proposing. Okay, Stephen has an interesting question in the chat about more equity when the economy is booming and investments are rich as compared to a downtime when returns are less sure. And you would have to offer at least as much as government investments. Okay, let's talk about that for just a second, because first I want to show this slide, which is the way that the investment world is going to think about your business is, if you think about that present value calculation, that's a one-time cash flow in the future, and then you calculate the present value of it today. What an investor will do is look at what they believe the realistic cash flows from your business will be, when they will occur, apply a discount rate that they consider appropriate, get a present value, sum them up, and say that's what your business is worth today. Okay, so in this simple example, we have a startup that's going to lose $200,000 in year one, break even in year two, earn $200,000 free cash flow in year three, grow to $600,000 in year four, break $1 million in year five, and then figure I'm going to hit maturity in my business and have free cash flow of 1.3 million from year six until it doesn't matter when. The best I can estimate is forever. Okay. The discount rate, we'll focus on that a lot in a minute. The discount rate is assigned based on some systemic calculations, like what is the T-bill rate, which we consider the risk-free rate, and then how much risk is there in this business. And then you just discount these cash flows back to today, and that's why this particular firm with these cash flows would be valued at $9,071,000. Okay, so if I was an investor and I believed all these numbers and felt confident in them and applied the 10% discount rate, I should be willing to give you $3 million for a third of your business. Okay, you give me a third of your business, you get $3 million cash. That's how you begin to build out your business with that investment. That's a super simple example. Okay, but this is the nut. This is the heart of how the investment world is going to think about your business. It's just going to look at those cash flows and try to figure out what they're worth today. Why should I give you that much money? I do want to take a second to talk about this R, right? That's the interest rate. You can call it the interest rate. We call it the discount rate. It's the expected rate of return. It's the price of capital. When you think about what am I paying when I borrow money, I'm paying R. I'm paying the interest rate or discount rate that that investor is requiring me to return for them to give me money today. Okay, important to remember, capital hates risk. The reason why the US government treasury bill is considered the risk-free investment is because it's never been defaulted on. It's never been paid late. A treasury bill from the US government has always paid on time in the amount the contract says it will. And because of that, essentially the world's capital markets count it as the risk-free rate. Your startup will not be risk-free. You will always pay a higher interest rate than the going T-bill rate, okay, which is currently 4.6%. If, and this is an enormous if, your business has the same risk profile as the general market, right now you would expect a discount rate of at least 10%. Okay, that's about right now what the market is demanding for an average type of corporation. Now let me explain what I mean by average. There's two different kinds of risks that your startup is going to pose to an investor. One is specific to your idea and your enterprise. We can call it idiosyncratic risk. And this is basically, you tell me you're going to make $1 million free cash flow in 3 years. There's a lot of risk in that, right? You don't have any, you have either no customers or a very small number of customers right now. We don't have a lot of proof about your ability to penetrate the market and gain market share. So I'm going to probably reduce my projections from your $1 million. Okay, that's idiosyncratic risk. That doesn't calculate into this formula, except it'll change my projections of your future cash flows up here. The other piece is called systemic risk. And this is about what kind of business you're running. Okay, and it depends on how sensitive your business is going to be to the general economy. If we have a recession, are you in a business which people are going to spend on anyway? Food, utilities, that kind of thing? Or are you selling a luxury good, which is possibly going to see a lot less interest in the market when people are feeling their purses are pinched? Okay, that's called beta. Some industries are high beta, luxury goods, very high tech types of equipment, types of personal goods, those kinds of things. And then there's low beta, utilities, gas, items like that. And the valuation of your enterprise is going to sort of depend on a few things together. It's a function of your financial projections, what you say you can deliver to the investors, the confidence that those investors have that you can deliver on those results, and the investors' evaluation of your exposure to systemic risk. So the thing that you have most control over is projecting your finances, putting together a good, solid story based on research about what your business is going to be able to do. The second thing you can influence, which is whether or not they believe you. We'll talk about some ways to help investors believe you. You can't do a whole lot about where investors are going to put your business in terms of systemic risk, but you should know where it is because that will affect how you understand what that discount rate looks like. Okay. And it's worth having a conversation with some people early on about just how much systemic risk your business is exposed to. Is this something people are going to pay for no matter what the broader economy is like? Or is this really something that people are going to shave off their budget when times are tough? Okay. So that's the fundamentals of valuation. Before I move on, because what I next one I'm going to talk about is your business plan and how you begin to create those financial projections. But are there any general questions about valuation, present value of money, different types of investments that I've talked about so far?
Yeah, I have a question about the cash flow. So for a startup that's at a very early stage with some users, but it's very early stage. We have a prototype, we have some pilots, but it's currently it's very hard for us to project how much cash flow we're gonna generate. I mean, we can guesstimate, but we don't know for sure.
Absolutely.
Do that.
All investing is based on guesstimates.
Mm-hmm.
Okay, that's really important for everyone to understand. All investing of any kind. I mean, if I didn't have to guess, well, then I would have bet on Apple 2 decades ago, right? If I knew the future, I'd be a lot wealthier than I am right now. It's always a guess. And what your job is as a startup entrepreneur is to, first of all, develop your story that you're confident in, that's based on the best information you have today, and then constantly iterate. And that's really the next thing we're going to talk about, is the process of constantly iterating on what you know about your business and what you can demonstrate about your business to build confidence in your story and to sharpen it. Okay? Because every single investment is always about buying future cash flows, which are always uncertain, with the hoped for exception of the US government treasury bill. Everybody keep your fingers crossed that there is no default on that, because that would be catastrophic. But for the time being, that's the one investment people can bet on, which is why the interest rate tends to be very low on the treasury bill. It's almost like a floor in the investing world. If you can buy treasury bills at 4.6%, you're not going to put $1 million anywhere else that's paying less. Okay. But after that, it's all speculation. So how do you develop that? Well, let's take a second. First of all, I think as I understand it, if you have gone to the prior sessions, you've already seen this model, which is your business plan, what you're developing incorporates your technology. Is it feasible? Can it be done? Analyzing the market, is your on enterprise desirable? Can you sell your product or service? And then is it economically viable? Now, the focus of this session is on economic viability of your enterprise. But I want everybody here to just take the next 2 minutes. I'll shut up for 2 minutes, and I want you to answer these 2 questions. Okay? Because this feeds directly into your ability to get money from investors. First of all, what is the most important unknown about your technology? If you were to say, what do I not have nailed down about my technology? What is it? And what can you do between today and the end of next week to get more visibility into that unknown? The second question is, what is the most important unknown about the market for my technology or product or service? The customer, competing products, how people interact with this part of the market. And what can I do by the end of next week? Give yourself Friday next week as a deadline to do one thing that will get you more visibility on the answer to that question. Okay, so 2-minute break. I want everybody to take those 2 minutes to write down those 2 things. Starting now. Okay, that's 2 minutes. Now, the reason why I want you to do that is because, again, capital hates risk. The more questions you can answer when you're talking to an investor, or at least show that investor that you are in process of finding these things out, the more likely that investor is to trust you and to stay with you through the process of thinking about your business and investing in it. Because what you're going to want to begin to do is to estimate revenues and costs. The profit calculation is super simple, right? How much money can you make? What's it going to cost you to make that much money? And what's left over to distribute to the investors? It's that simple. Right now, that's all going to be guesses and estimates. Over time, you're going to be able to give more evidence for why you have those numbers and why you believe in them. But at any point in time, you want to have a convincing case for where you are in the process. Be honest about where you are in the process and build a convincing case for it. So the key is define your clear vision, where your business is going, identify your assumptions, and just keep testing. And then do this over and over. It's the think, do cycle that I think has been presented before in Big Bang workshops, right? That is your challenge as you go through, because this will link directly to your business plan, your case, and your sell to your investors. So let's take a second. I think this has been presented before, but revenue models, right? Who is your customer? What are they buying? And how do you get paid? Okay, and there are lots of options. I mean, I can imagine just from the ideas I've heard, like, who is your customer, Ty?
The customers are universities, so we target universities, and it's going to be a subscription-based model.
Do you know who at the university makes this decision?
Well, currently we talk to the IT people, IET.
Wrong. I'm going to tell you right now, you're talking to the wrong people. Okay?
Yeah.
All right. And I'm sorry to pick on you, Ty, but I want everybody to think about this. You need to know who you're selling to. And as an administrator at UC Davis, I can tell you that IT people don't make this decision.
Mhm.
You have a product that you are going to need to sell to the academic units. They're the ones who have the budget control. They're the ones who are going to make the buy decision for this particular product. IT on the UC Davis campus will have nothing to do with this decision. The only thing they will care about is if there's security risk in it. Okay? So you should start talking to people in my position, assistant deans. You should start talking to academics who have, you know, they will be replacing TAs with your product.
Mhm.
And you want to find out whether or not the TAs are, you know, is there a risk? Is there a need for this? Okay. So when you start to think about the money, you have to think about who makes the buy decision. It's not always the person who will benefit directly from the product. All right, but you need to find that person and find out what matters to them. And I'm just not just saying this to Ty, I'm saying this to everybody on the call. Who makes the money decision to buy your product? What does that revenue model look like? And up on the screen, you've got unit sales, advertising fees, franchise fees, utility fees, subscription fees. How are you going to sell? What's the revenue model look like? Right? Then you want to build out how much money you're going to make. So what's that price? Is it a price per unit sold? Is it a price per view? Is it a price per prescription or per subscription? You know, as I think about, Stephen, what you've got, is this something that the university is going to pay for? It sounds to me like this is not a product that the academics are going to pay for. This is more of a social service for campus, for student mental health. Is that about right?
You're right on. At least that was our initial assumption. And then, like you said, we had to take a lot of pivots through discovery calls and market research to identify. You know, it's funny, your question. So Ty actually led right into that, because the response to my second question that you had about the unknowns for the technology product in the market, it had to do with, right now there's a budgetary deficit in the state of California, and trying to approach state colleges when they're not going to open their wallets. You have to get creative with how you go to market. And so recently I found somebody who told me Division of Housing is really going to be my best shot in terms of finding somebody who doesn't have some of the red tape that comes with the budget decisions. But that, you know, that's still needs to be proven, right? So in the next week, you know, that's where I go and I talk to the Division of Housing at those campuses I'm piloting at, to go and figure out more information in regards to if that's going to work budgetary wise.
Yep. And really in those conversations, whoever your customer is, a lot of open questions. What do they care about? What are their pain points? You know, can your product save money? You know, if your product can actually help the university identify students who are, you know, failing academically or struggling with mental health issues or whatever it is, if you can start to tap that potentially saves the university tons of money downstream. If they are able to get early interventions, save the university headaches and trouble that all those other issues create, right?
Yeah.
So you want to really listen to what are your customers' pain points and how are you going to solve them with your product? Hopefully save them some money. And I realize, Julianne, that I'm going really slow here, so I'm going to pick up the pace a little bit. But this is your revenue side. You want to know your customer. You want to understand how you're going to sell to them and how much they're willing to pay. It also matters because if you have to have them willing to pay you more than it's going to cost you to make, at least in the long term. You're probably going to lose money on your first sales. It's normal. It's normal for a startup to have negative cash flow. We'll get to that in just a second. But as you go, you want to have a model. Okay. As you go, you want to have a model where you're going to eventually make money. So the first question is, what's your revenue? How are you going to sell? How are you going to make that money and how much can you make? And then what's it going to cost to produce? So for example, if you're selling a product, what's the development, the R&D, the development of that product? What's the cost per unit sold, right? What's it going to cost to produce a single unit of your product? And then other cost of operations, the marketing, the administration. Okay. And sorry, okay. Your eventual goal is to be able to start producing financial projections. These go by a lot of different names: pro formas, P&Ls, profit and loss. Some of us call it a draft income statement. But what this is a picture over time of your venture's revenue, expenses, and profits. These are always your best guess predictions based on assumptions you've made, based on research you've done. The more you can test your assumptions with research, conversations, especially real customer conversations, the better an investor is going to look at your financial projections, right? Because you have tested them yourself. You've stated your assumptions, you've shown that you've tried to research those assumptions, and you're constantly doing that. So that as you engage in conversations with investors, you're developing your financial projections. Okay, one place to start, and we're going to take another 2 to 3 minute break here for you to do this, is what's called the 3x5 rule. Okay, what are the 3 most important drivers of your revenue and expenses over the next 5 years? Just start with the big 3s. Okay, and how will they grow or shrink over the next 5 years? So as an example, and then I'm going to take that break, think about this company and what they're looking at. The 3 most important things, the 3 most impactful revenue factors for them is how many customers they have, how many units each customer will buy, and what's the price per unit. So I pulled some figures for a vet med startup where they're producing a new imaging machine. And this is where they had their projections, right? Number of customers, number of units per customer per vet med clinic, and price per unit that they were going to sell it for based on their market research. And that gave them these top line revenue numbers for their enterprise over 5 years. Then what were the 3 largest cost factors? The headcount is just the employees they figured they were going to have to take on. Cost of goods sold, this is the cost per unit, which they figured was going to be $2,000, but as they got to scale, they were hoping it would drop. And then the customer acquisition cost, what's the cost per customer acquired? Marketing budget, okay? So what I want everybody to do, and then they projected all this out for 5 years. You're not going to have time to project the numbers, but just think about, for the next 3 minutes, think about your 3 biggest factors in how you're currently thinking about revenue for your company, and the 3 biggest cost factors as you think about how your company is going to produce value. Okay, so you have 3 minutes just to sit down and hammer those out, brainstorm them. If you can sell the story mitten, then it is not too bold. Okay, so that's been 3 minutes. Did anybody have any ahas or puzzled queries as you tried to think about what's going to drive revenue, the 3 most important elements to drive revenue, the 3 most important elements to drive cost?
Are you looking for volunteers to?
Anybody at all? Yep.
All right, cool. Yeah, so my 3 biggest revenue streams are student premium version access, admin software licenses, and cost per click advertising. And the biggest expenses are cloud service expenses, customer acquisition costs for both students and administrators, and then digital advertising and marketing materials, and so effectively the outreach. I consider those to be different because I do think that there's certain digital marketing and that can't be quantified for the CAC.
Okay. In terms of dollars out the door, are you going to pay anybody? Developers?
Good point. Yeah, labor.
Okay,
employees.
yeah. My guess is, yeah, so as you're thinking about your business, we're looking for the 3 biggest drivers. 3 largest, like if I was to look at your business 4 years from now and take a quick look at your income statement, what is going to drive those numbers the most? The ones with the biggest number of zeros, biggest number of places in the number. And my bet is if you're running that company, Stephen, it's going to be developers, and it's going to be developers. At least in the beginning, it's going to be developers, and eventually it'll be salespeople. But in the beginning, it's going to be developers, right?
Yeah, you're totally right. I guess I wasn't thinking clearly because you're now that I think about it, I'm like, yeah, obviously there's other expenses that are going to be, yeah, app dev in general, cloud service. I was just picking that one, but app dev I lumped that in with the contractors.
Okay.
I see what you're saying now.
Okay, but you gave me an opportunity to point this out, so thank
You
you.
did. Yeah, you're welcome.
So for everybody else on the call, the focus is, what are your 3 biggest numbers? That's what your investors are going to care about, right? What are your 3 biggest revenue numbers, drivers, and numbers? What are your 3 biggest cost numbers? You can probably get 80% of total revenue and total cost with those top 3. And then the others are going to matter. But the other thing this does is keeps you from going into too much detail. Because as we've said, it's all guesstimates and projections right now. You don't have all the information you need, and you won't, frankly, until you're running the business for a few years. So go ahead and accept the level of ambiguity you have right now, but keep digging. So here's some thoughts on that, right? You want to keep building confidence in your numbers. How do you do it? Okay, the most important thing, what an investor is going to ask about is, how many customers have you talked to? What is their feedback? All right. And then real market analysis. What's your total available market? How big is the market for your product? How do you figure that out? There's a couple of ways. The best way is if you've got something you're replacing and you know how big that market is, right? You can make big estimates. If every university on the planet took your service, that's the total available market. Do you have any idea what they're spending on comparable services right now for your product? Okay, so you can not just talk about size, but value of the market. And then you want to have realistic projections. Okay, be ambitious. You're an entrepreneur. You're supposed to be ambitious. That's okay, but be realistic. Don't paint unicorns and rainbows. Paint horses that run across fields effectively. Okay, but do it with ambition. Do it as realistically as you possibly can to describe the market you think you can obtain within a reasonable period of time and how you're going to get there. So answering those questions and constantly developing your answers to those with more information will build confidence in your numbers. It'll build your confidence. It'll also build the investor's confidence. What else can help? A working prototype, right? An idea is an idea. Once you've built a working prototype, that's good. Okay, the next best is a working prototype adjusted for customer feedback. If you can get your prototype into the hands of or in front of customers, and it sounds like some of you already have, which is fantastic, tell the investors how you started and how you've adjusted and how you're constantly doing so, how you're developing that prototype so it fits the market better. Okay? And then a sale. The absolute, going back to the very beginning, what's a pie worth? A pie is worth $5 or $8 because a willing seller and a willing buyer agree on the price in an arm's length transaction. An arm's length transaction is a transaction where there's no other externalities in the transaction. So this isn't that you sold a pie to your mom, okay? This isn't that your best friend bought your pie. This is somebody in the market who doesn't care who you are and has no relationship with you bought the pie. Then you know it's worth what they paid for it. Okay, that's a real sale. If you have a real sale, then you're already on your way because you demonstrated that someone is actually willing to part with their money for your product or your service. Okay, question to the whole group. What's better than a sale? What's better than a sale? What's that, Camille?
Free.
What?
I
Free?
said $0. Yeah.
No, that's great for your customers. It's lousy for you because if it's free, no, you're not going to make any money. But Nitin put it in the chat and he's 100% right. More sales. Okay. So it's easy for potential customers to tell you that they love your product. But if you get them to part with money for your product, huge difference. Huge difference. Okay. And so when you can, starting to test this hypothesis and starting with a sale is great, and then try to build on it. All right. But that's when the value of your business is going to jump dramatically when you have your first sale and then you have multiple sales, because now you can demonstrate to investors that you can actually generate revenue. Okay. Now, That's how you get your revenue and your expense numbers and build confidence in the numbers. But you're going to need cash in the beginning because you're not going to generate enough money to be to have a positive cash flow at the beginning of an enterprise. It's extremely rare. Okay. Usually you're going to have investors and they're going to have to give you money, which gives us the famous J curve. How much cash do you need? The J curve is a simple curve that is talked about a lot in the investment business, which says if you started a business here in, well, on this graph, it's 2009, and you lost money for 4 years, and then hit the break-even point in your 4th year, and then started generating positive cash flow, you still have this period of 4 years where you have negative cash. And for those who like graphs, the area under the curve is how much cash you're going to need over those 4 years. That's the net cash that you're going to have to get from investors in order to make your business run. Okay, the initial investment, your operating expenses, till you can generate positive cash flow, and then eventually, you know, do the classic entrepreneurial hockey stick and be generating unbelievable amounts of cash in a few years. Okay, so this is the J curve. How much cash do you need? And the way you calculate that, well, the way you calculate it goes back to your projections, where you figure out how much you're going to lose over a series of years until you break even and start to get to zero and then start making cash. Where do you get that cash? This is one example. The particular enterprise, the particular business is going to be unique, but this is a good taxonomy of the types of investors who will invest in your business, in your idea, and where you need to be, right? So especially at a university, research grants and small business development grants are great. Free money is the best money. Money you don't have to return is 100% the best money as you're developing your business. Okay? Because you don't have to pay it back and you can run for a little bit of time on it. Eventually, you're going to have to start taking money from investors, people who are going to expect a return, who are going to be thinking in terms of what's that future cash flow I'm buying. Okay? Sometimes you can get it from friends, family, and founders. You put in your own money, or a friend or a family invests because they believe in you. Okay. The next group of people you might want to be talking to are called angel investors. Angels are typically people who have something to add to your business besides cash. And they might be willing to add something more than cash, their own expertise. They know something about the business you work in. So they're willing to put up money because they believe you've got a good thing going and they know enough about the business to value it better than the rest of the market. They may also care. Earlier, I said the market doesn't care about your idea. Angel investors might, right? Somebody who really cares about education, who cares about how students experience the classroom, might care about Ty's idea, might care about Stephen's idea, and really want to see it succeed. So they'll not only put money in, but they'll put other types of their effort in. But once you move past these initial types of investors, it's really just about cash flow, future cash flow, and how much you can return to the investors. Early stage venture capital firms or VC firms, private equity project financing, where you get into the bigger money. And here is where you're really going to be needing lawyers, okay? You really want to have a lawyer as soon as you sell any equity or any share of the company's equity to start with. Okay, but once you're out here among the VC firms, these people are super clever, know how to write a contract, and having sat in the meetings with them, if taking your company for themselves is the best way to get their money back, they'll do it in a heartbeat. Okay, so read the contract carefully and make sure you got an expert on the other side of that who's reading it along with you. Okay. If the tech doesn't need research, are there equivalent grants, HHS, other grants? You might be able to get some small money. I have not seen a ton. Yeah, small business. It's part of the Small Business Administration, and you can get small grants to develop ideas for business. Okay, that's what SBIR is. Mostly if you're not in working at the university level to develop this kind of tech, you're probably going to have to start taking on investors who are expecting a return, not grants. Okay. Your maximum negative cash flow, everything here below this line, that's what you're going to have to find investors for. So, since you're going to need money before you make money, you need to know how much money you're going to require and when. You're going to need to know how much you might be able to make and when to develop that financial timeline and convince people that it's worth their money, worth giving you their money so that they get a return. Okay? What that will mean is selling parts of your company to your investors, especially for a startup. So the investment world talks about two different kinds of investment. Debt investment, which is where they lend you money, you sign a contract and agree to pay it back. If you don't have positive cash flow in your business, not a lot of banks are going to give you that kind of investment because you just don't have the demonstrated ability to pay it back. Most of the time, you're going to have to dilute your ownership and sell part of the company to an investor. And this slide just demonstrates some examples of what that looks like. When you found the company, there's going to be a division between the founders and maybe some options to offer to other people. When you go into a seed round with your first investors, you're going to have to sell off part of that, which will dilute your ownership. Not to worry too much because the value of your firm, there we go. Thank you, Stephen. Value of your firm is increasing as you go through these investment rounds, if you're successful, because you are demonstrating the ability to generate cash. That will make your business more valuable. And so even though your percentage ownership of the company is going down, the value of that ownership is going up. Okay. Now, this is just a taxonomy of some of the quantitative elements of your business plan. It needs to demonstrate that the problem is real, causes economic pain. You need to provide evidence of the size and scope of that pain. You need to demonstrate that you can cost effectively relieve that pain on a per unit basis. You can describe the dollar amount of investment required to bring the solution to market, predict those sales, and then demonstrate that those potential profits are worth that investment today. And I just want to take 1 minute to talk about what that upside in the future for investors looks like, because you may want to think about your business now in terms of what is the exit. The exit is when an investor, particularly a venture capital firm, enters the investment with your company. They're looking for an exit. There are three classic types of exits, right? There's the IPO, the initial public offering, which then the shares are in the public domain and can be bought and sold freely. So that is one way to go. The other one is you sell your company to a larger company. Okay. The less frequent way for startups is dividends, that you're generating so much cash that you're giving cash back. Instead of using it to invest to grow, you're giving cash back to your investors. As your company grows, you can make choices to think about, do you want to go IPO? Do you want to have a separate standalone company that's traded on the markets? Or do you want to pre-package it for an acquisition and start those conversations early? So for example, a lot of pharmaceutical startups are talking to the big ones, Pfizer, Johnson & Johnson, and others, early on, because what they're really looking to do is to get through the trials, demonstrate that their drug works, and rather than go into some large manufacturing process, sell it off to one of the big drug manufacturers. Okay? But this is what the big investors are looking for. They're looking for the exit, which they usually expect to do in 5 to 7 years after their initial investment. Okay. This last slide is just some take-home recommendations, and one thought to leave you with before we go to any other questions, which is just, you are part of the investment right now. When you stand up in front of investors and pitch your company, you are part of it. So it's how much do you know? How many questions have you answered? What are your current assumptions? Are you prepared to answer their questions? and to show that you can be a partner in the development of your business with these investors. And you also want to make the case that you are the best person in the world to make your idea real and profitable. So any questions about any of it?
Wait, can you go back to the exit part?
The exits, yeah.
I'm still a little confused about this part. So the exit is for you or for the investors?
Okay, if you take on an investor, you and they are the owners of the company. All right.
Right.
So when you take on an investor, whether it's a venture capitalist or a big bank or whatever, they are frequently taking an equity position in your company, which means they own it along with you. And I want you to take a second to go back to the beginning. Investors think less, investors, after the angel investor group, they think less about your company as a company, and they think more about it as a set of future cash flows. So when they buy your company, they're buying future cash flows. All right, that's how they're making their decision. They're estimating future cash flows. They're estimating how risky they are, how confident they are that they're going to materialize. That's what they're buying, right? Angel investors might care about your business idea. Bigger investors are mostly just caring about future cash flows. So once they have bought into your company and they are equity holders alongside of you, now your interests are tied. And when the exit happens, you and they will both benefit if it's a good exit. Okay? So for example, you own shares, they own shares, it goes, it goes to initial public offering. That's a whole nother conversation about how that happens, but the short version is on a particular day, you have a partner bank who has already identified people who are going to buy in, and whatever percentage of your company you put out there in the public market sells, right? And after that, it's out there. So what the company gets is the initial cash from those initial sales. And then after that, if it's being bought and sold out there in the market, that money exchange is not between the company and the investors, it's between shareholders, right? Companies only make money on the market when they either issue new shares or buy shares back. Okay, that's an
So
idea. Go ahead.
Right. So how is dividends kind of exit? Because like if you're getting the dividends, like you still hold the shares, right? So you're still in it.
Right. So dividends is just share distributed to owners or cash distributed to owners, right? So I don't want to make this too complicated, but you can have some shares, like privileged shares, that are promised a dividend, common shares that are not. But you have companies that have a tradition of distributing dividends to all shareholders. You have companies that don't, that hold their cash and use it to grow the company. It is generally seen, dividends are generally a case where you have a mature company with positive cash flows and not a ton of growth opportunity. Utility companies do a lot of dividends. Bigger, mature companies might have a tradition of giving out dividends. Startups generally don't. It would be later in the process where dividends would be how you get your cash back out of an investment.
Right. That makes sense.
Right. And the acquisition is simply, a much larger company comes along and buys your entire company for a large sum of money, which is then distributed to the owners. And that is also a very interesting and sometimes complicated process. The founders may, sign an agreement to continue working for a couple of years at the company. There might be something called an earn-out clause. So the amount of the new purchasing company is willing to pay for the startup is dependent on performance over a few years, and you earn part of the purchase price as you go, right? So there's a base price, but then there's an earn-out period where more money is distributed to the owners based on expected performance.
And can you like mention a little bit of like how the options work?
Yeah, options are basically where the company gives frequently, well, there's options within the company, right? So it's a form of compensation to people who work at the company. And what you do is at a particular point in time, you give the person the option to buy at a particular price. Okay, and so usually it's a favorable price. And if you hold on to the option, you can hold on to the option, so you're not actually paying for it right away. You don't lose any cash right away. And then if you see the value of the company go up, you go ahead and buy in at the price that it was offered at. That's one form of stock-based compensation. Another form of stock-based compensation is just, please come work for us for not that many dollars because we're going to give you stock in the company instead. Right? That was a very popular way that a lot of the tech companies grew.
Right. And is that like equity or equity is
Correct.
different?
Yeah, and both of these are forms of equity, or stock-based compensation is a form of equity. One, if it's actual shares, then you own the shares and you have a claim on the company's future cash flows right away. If it's an option, then it's essentially a contract that may expire in the future that allows you to buy into the company at a certain rate, at a certain price.
And the shares, is that depends on how you like divide your company, or like how does the shares work? You know, there's like
So so shares, think about it as like a percentage of the company. The number of shares is completely up to how you sort of write the contracts and develop out the ownership shares. It can be a few thousand, it can be 3, it can be millions. And each share represents a proportional ownership of the company. Again, the way the investing world looks at it is each share gives me a percentage claim on the future free cash flows of the company.
right.
So when I buy a share, I don't really care that I get to vote for the board of, directors, unless I'm an activist investor. All I really care about is I get to claim a part of the future cash flows of the company. And I can, if it's a publicly traded company, like you see on the NASDAQ or the Dow, then my future claim comes from my ability to buy or sell that share. It may have a dividend attached, which is a future cash flow I'll think about when I think about what I'm willing to pay for that share. And it may also be, my expectation that this company is going to be acquired soon. Right, and I'll be bought out. For startups, it's generally I should be careful. For startups, it can be very simple, right? A certain number of shares that represent a certain ownership in the company. But again, once you're talking to the venture capitalist folks, it can get exceedingly complicated. With convertible debt is an instrument that's often used where someone lends money to the company with a contract, but they can convert that debt into equity at a future date if they think it's favorable to them as an investor. And so they go from being a debt holder with a fixed rate of interest returning to them to an equity holder where they participate in the upside of a growing company. And it's a complicated contract that defines the terms of that conversion. And again, that's why you want lawyers by your side when you're looking at these. Yeah. And in the investment world, we talk about investments that are senior to other investments. So at the very top, you're probably going to have bank debt, which is a simple contract of a loan with a fixed interest rate. And at the very bottom, you have the equity holders. And the reason we rate it like that from top to bottom is because in a bankruptcy, the people at the top get the most, and the people at the bottom are wiped out. So if your company, God forbid, if your company does not turn positive cash flow and can't make a bank payment, then the bank can take you to court and seize the assets, and that's when a judge figures out who gets paid and how much. And what the judge will look at is who's senior to who pay off the top people first, and then go down until there's nothing.
So do VCs generally like exit after a period of time? Like, I mean, like, do they like sell their share or like?
Right. So the way VCs and the way these large investment funds work is they are usually made up of various partners. And the VCs are called the general partners because they run the fund. And then you have limited partners who put money in for them to manage, for the VCs to manage. So the pressure on the VC is they have to return money to their limited, what are called their limited partners. Because what a VC generally wants to do is to open a fund, run it for 5 to 7 years, demonstrate huge returns, go back to the market and say, I can do this for you again. And I want more this time. And so they grow their fund. The reason why VCs love to grow their funds is because the way VCs get paid is the classic is called 2 and 20, which means they get to take 2% management fee off total invested capital per year. So if I'm running, a $100 million fund, then I get $2 million per year no matter what happens. If I'm running a $500 million fund, I'm getting $10 million per year no matter what happens. And so then the 20% is once the total investment of the fund has exceeded a certain cap, the VC themselves get 20% of the return. Okay, so in addition to returning of the 100% of return above principal, they're going to take 20% of that, and that's where the 2 and 20 comes from. Now, 2 and 20 for a while was an industry standard for VCs. The hot VCs were able to claim more, give me 2 and 30, or some other more complicated, what they call the waterfall, which is how the money flows out of the fund when they're exiting. So to sort of, sorry, I'm wandering a bit, but to get back to your question, every VC is looking to exit their investments within 5 to 7 years. And whether they invest it by finding somebody else to buy their interest in the company, different funds have different sort of sweet spots, like early venture, I'm buying at the beginning of that process. Late venture, the company is established, they're about to IPO, that's my expertise. You might have a late venture fund buy an investment off an early venture fund. Okay, but they all want to get out in 5 to 7 years because that's sort of the life cycle.
Right, and they can participate like actively or like inactively.
Right, exactly. So yeah, you'll have VCs. Angel invest, it kind of runs a bit along that line. Angel investors will probably want to be heavily invested and involved in your company. They usually believe they can add value through their expertise. Venture capitalists, and it's not wrong, starting up a company is a learned skill. And if you can find the right partner investor who knows what they're doing as a coach and is willing to work with you, then that's a great partner to have because they bring both money and expertise. What they will also, the thing you have to look out for is sometimes they also bring their own CEO. And their goal may be, and you just need to have these conversations up front. Their goal may be to put in their own operator, right? And so, they may have somebody who they believe can run the business better than the founders, right? And sometimes they can, which, it's as they say, do you want to sleep well or eat well? Sometimes it's better just to sleep well, let the company go, take the cash at the right time, and sleep well. Nitin asked, are you allowed to use your own IRA? In other words, to borrow from your IRA to invest in your own startup business? Take care, Stephen. Thanks for the questions. And the answer, Nitin, is probably yes. I don't think there's anything illegal about it. Once you borrow money from your IRA, I think you can do anything you want with it, depending on the terms of the IRA agreement. But again, if you're borrowing your retirement funds to fund your startup, you just want to think very clearly about that choice, how certain you are it's going to succeed, and how much you need the IRA.
Do you have any suggestions on where to find VCs?
The Institute for Innovation and Entrepreneurship at the Graduate School of Management has a fantastic network of people who can, I think, help you learn how to network into that group, attend their Big Bang. There will be people looking.
Okay.
And if you are doing the right stuff, it is not unusual for the VCs to find you. One of the things that VCs specialize in is what they call deal flow. So they hover around places like the Institute for Innovation and Entrepreneurship because they're looking for deal flow. They want to be in the early stages of finding the next big idea. That's part of their business. It's not purely philanthropic when VC representatives are showing up at the Big Bang business competition.
Mm-hmm.
And Julianne just put her email in the chat.
Okay, thanks.
And Nitin, you asked, how do you decide if it's the right time to engage with the VCs who contact you? I think you can always have the conversation. If they're reaching out and contacting you, go ahead, take the conversation. That's a fantastic opportunity. Engage with them. And I'm sorry, it's just I was in the room with these guys and they're sharks. They're really smart, capable, they can be extraordinarily helpful in building your business. But most of them are driven by the profit motive almost exclusively. So just be aware of who you're getting in the water with and pay attention. It's not a bad thing. It's just how the market works.
I have another question.
Sure.
So earlier we were talking about like a lot of VCs are like see like companies as like a cash flow, but like companies like Snapchat or things like that are always losing money. Why would they still put money into a company like this? Because it seems like it's always a negative like cash flow.
So I don't know enough about Snapchat specifically to know sort of what the calculation is. But
Right.
blitz scaling, that's right. And so in a company like the way that an investor looks at cash flow is really different from how accounting portrays a company. I mean, think about Amazon. How many years before Amazon was producing any kind of positive cash flow? But now, of course, they are. And the people who hung with them and looked ahead and believed in the model and believed that they were going to start making money, well, they made the right bet when they made it if they got in early at the cheap price. And that's why the investors believe that a company is worth something, is because they're looking at the performance, they're looking at what they believe the future will look like. You can also have companies that are cash flow positive. I won't name it, but I'm looking at one right now because it's relevant to my job. But there's a company that's actually doing fine. The problem they have is that they're carrying a big debt load. And even though they can pay the interest on that debt load, it's coming due in about a year. And so the market is hammering them because the market doesn't believe that they're going to be able to turn things around and get the kind of cash flow they need to pay off that debt. Right? So it all depends on these, and again, for everyone on the call, it's always about future projections. And it can go either way. If they believe in you, if the market believes in you, like Snapchat, like Amazon for years and years, then they'll keep investing and giving you the cash to keep operating.
Hey, let's see. We are very close to time. Jim, how are you? I see, anybody have maybe one more question, or we can kind of transition to Big Bang questions. One more question for Jim.
Stop share there. Sorry about that.
Jim, this has been incredibly interesting and so useful. I have learned so much. We've had fantastic questions. Thank you all for engaging. You just asked really thoughtful questions that I think probably helped everybody else on the call too. And Jim, I felt like I was in a class and really like an MBA class. So, thank you so much for volunteering your time to do this because it was just a wealth of information, very valuable.
Okay, well, I hope it was useful to you all, and I really wish you all the best for your ideas and your business ideas and your entrepreneurial efforts.
Okay, thank you, Jim. You could sign off if you want. I'll stay on for just a couple more minutes if anybody else has questions about Big Bang.
So I did have a question about eligibility.
Mhm.
So I noticed that it's any California school in a relationship. So is that alumni included in that as a relationship?
Yes. So the only requirement with regards to the California affiliation is that you need to have at least one co-founder who is affiliated with the California Institution of Higher Education, either as alum, staff, faculty, or a student.
So that includes Sac State,
Mhm.
community, it's like Folsom Lake Community Colleges and UC
Yes.
Davis. Okay.
Yeah.
And it just needs to be one. And if you have more than one, that's not any here or there.
Right.
Okay.
Yeah.
All right. Thank you.
Mhm. Okay, so just a final reminder that deadline for round one registration is February 26th. So you'll want to get your executive summaries together and your team member bios. And I really encourage you to try to register a day before the deadline because sometimes there are technical issues like kind of at the deadline. And not taking any late submissions this year, but you're welcome to reach out to me at any time if you have any questions. If you're trying to upload materials on the 26th and you're having issues, just shoot me an email and I'll help you out.
Oh, I did have one other question.
Mhm.
So I applied last year as well. So there's a limit to 2 times that you can apply.
Mhm.
With the same idea, or is it 2 times with the same company? If you
Oh, go ahead.
if you
Sorry.
pivoted, is it considered a different thing, or is it like if it's a completely new idea, is it a different thing? Or
Yeah, it is a different thing.
okay.
So a limit of you can only apply with the same idea 2 times.
Oh, that's fair. Okay. Thank you.
Mhm. Okay, well, if there are no more questions, I just want to thank you all again for coming and engaging and just helping to make this a really effective workshop. And yeah, I'm always here if you have questions about Big Bang, and I look forward to seeing your submissions.
Thank you.
You're welcome.
Thank you.
You're welcome.